Okay, so you want to own a Rolex, not wear one, own the business. Become an authorized dealer. Buy watches at wholesale, sell them at retail, collect the difference. Simple. Except here's the strange part, you can't just do that. There is no application form. There is no price list Rolex will send you. And depending on who you ask, no new authorized dealer has been added to the US network in any meaningful way in years. The list of roughly 1,800 dealers worldwide barely moves, and getting on it usually means buying an existing dealership outright, sometimes for tens of millions of dollars, just for the right to sell watches you don't get to price. By the end of this video, you'll know exactly why becoming a Rolex dealer isn't really something you apply for. It's something you inherit or buy your way into. How the dealership actually makes its money, and it's not what you think. Why the exact same watch can be worth $10,000 more or $10,000 less than retail, depending on the week you're trying to sell it. Why the company at the center of all of this technically has no owner who can cash out. Let's start with what it costs to get in. A small operation is a single-case arrangement inside an existing jewelry store, a glass counter, a handful of steel sports models, maybe $200,000 to $500,000 tied up in inventory at any given time. A real boutique, the kind with the green awning and its own storefront, runs into the low millions once you account for build-out, security, and the inventory Rolex requires you to carry across its full catalog, not just the models that sell themselves. And then there's the top tier, a flagship like Wemp on Fifth Avenue or the multi-brand Palace's Butcherer built across Europe. In 2023, Rolex did something it had never done in its history. It agreed to buy Butcherer, one of the largest watch retailers on Earth, effectively becoming its own biggest customer. That's not a small business anymore. That's vertical integration at a scale almost no other watch brand attempts. Why has it taken this long for anyone new to break in? Because building the store was never the hard part. The hard part is that Rolex controls who gets to sell its watches, and it isn't taking applications. Dealerships get bought, sold, and passed down. The barrier isn't capital, it's access, and access is the one thing money alone doesn't reliably buy. Now the question that actually matters. It's not the sticker price of the watch. It's the gap between what Rolex charges its dealers and what the dealer is allowed to charge you. Dealers reportedly pay somewhere around 60 to 62% of retail for new watches, a gross margin in the high 30s to 40% range. Sounds like easy money. Except once you subtract rent, staff, insurance, security, and the fact that Rolex requires you to stock unpopular references alongside the ones with 2-year waitlists, that headline margin collapses. Dealers and industry forum veterans consistently put the real net profit margin on new Rolex sales at somewhere around 10 to 14%, closer to what a car dealership clears on a new sedan than what people imagine a luxury margin looks like. And here's the part that breaks people's brains. The dealer barely wants to sell you the watch everyone's asking for. A steel Submariner or Daytona might have a 2-year list and a locked retail price, meaning zero pricing power and zero incentive beyond volume. What the dealer actually wants is for that same customer to also walk out with a bracelet, a gold model, a piece of fine jewelry, something with real, uncapped margin. The hyped stainless steel sports watch isn't the profit center. It's the traffic driver. That's the entire business model in one sentence. A Rolex dealership is not really in the business of selling the watch you came in for. It's in the business of the gap between wholesale and retail, between what's allocated and what's demanded, between the watch that gets you in the door and the watch that actually pays the electric bill. Now the part nobody puts in the marketing material. Every dealer is quietly running 2 completely different markets under one roof. Market 1 is new retail at fixed prices Rolex sets, where margin is thin and predictable. Market 2 is the secondary market, and it moves like a commodity because it basically is one. In March 2022, at the peak of a pandemic-era buying frenzy, a stainless Daytona was trading around $53,911 on the secondary market, more than double its retail price. By January 2023, that same reference had crashed to roughly $27,642. It has since recovered to around $38,000. The Submariner told a similar story. A May 2022 peak near $18,889, a dip to about $13,600 in early 2023, and a partial recovery since. An index tracking the top 30 Rolex references peaked above $17,000 in March 2022 and fell to under $12,000 by that December, a nearly 30% swing in under a year, on watches that never left the factory. This means anyone holding inventory, dealer, or gray market reseller is essentially running a leveraged bet on where that gap sits on any given day. A dealer who bought steel sports inventory in late 2022 near the top could be sitting on watches worth 20 to 40% less today if they need to liquidate. That's not a hypothetical. Analysts covering the space have described exactly that scenario. A Daytona bought wholesale at $38,000, now trading closer to $32,000 on the very market that used to reward patience. Here's the part that explains the regional and channel disparities you might have noticed. Gray market dealers in Hong Kong or Dubai, where there's no VAT dragging down the math, can absorb a wider spread than a dealer in a high-tax European country. And Rolex has been actively working to shrink that gap, tightening gray market supply by adjusting allocations and pushing more inventory toward precious metal models instead of steel sports watches, which analysts say is a deliberate move to relieve pressure on the exact segment that made this whole spread trade so lucrative in the first place. So with that spread theoretically working in the dealer's favor, why is this one of the more fragile retail categories to actually run? Two forces. Force 1, the margin compression nobody plans for. Rolex raises retail prices most Januaries, but secondary market values have been sliding since 2022, meaning the resale cushion that used to protect dealer inventory has been thinning out. Morgan Stanley's analysis found the secondary market falling broadly across brands, with Rolex among the steeper decliners in some periods. A dealer sitting on aging inventory purchased near the 2022 peak isn't protected by the brand name alone. Force 2, the liability sitting behind the glass. In September 2025, 6 men smashed their way into a Rolex boutique on Chicago's Magnificent Mile in broad daylight, using hammers to break the display cases while a customer and employees hid in a security room. They got away with roughly $170,500 in watches before a police chase ended the run. It's one incident among dozens like it across the country in recent years, because unlike almost any other retail category, the entire inventory behind a Rolex dealer's counter is small, liquid, instantly resellable, and sitting in plain view of a street-facing window. The insurance, the vaults, the armed security, the glass rated to survive a hammer, none of that shows up in the sticker price, and none of it is optional. Step back for a second. A Rolex dealership is a paradox the same way a casino is. The demand is guaranteed. There are more people who want a Submariner than watches allocated to sell them, and yet the margin sitting in front of you is thin, volatile, and constantly exposed to a market it doesn't control and a security risk it can't fully insure away. Two scenarios, real numbers. Scenario 1, a single-case dealer inside an existing jewelry store. A few $100,000 of tied-up inventory, thin annual allocation, a 10 to 14% net margin on whatever actually moves. In a good year, real take-home profit from Rolex sales alone might land in the low tens of thousands, meaningful, but not why the store stays open. The real reason to carry the brand is what it drags in the door. Scenario 2, a scaled multi-boutique operator, the butcher-scale business Rolex itself decided was worth owning outright. Hundreds of millions in annual watch sales across dozens of locations, margin protected by scale, security budgets, and negotiating leverage most single-store operators will never have. Same 60% wholesale cost, same capped retail price, but the operating leverage changes everything about whether that thin margin turns into a real business or a break-even hobby with a security bill attached. In 1945, Hans Wilsdorf, the man who built Rolex from nothing, gave it the first waterproof case and the first self-winding movement, did something almost no founder in history has done. Following his wife's death, with no children to inherit the company, he placed his entire ownership stake into a private Swiss foundation bearing his name. When he died in 1960, there was no heir, no sale, no IPO. The foundation still owns Rolex today, in full, with no public shareholders and no obligation to disclose a single number about profit, revenue, or where the money actually goes. Nobody has ever bought Rolex. Nobody ever wills. You can own a dealership that sells its watches. You can own the watch itself. But the thing everyone assumes is the ultimate prize. Owning Rolex was never for sale, and the man who built it made sure of that on purpose.